In this video, we're going to talk about all-in-one loans and how you can use this to quickly pay off your mortgage. Coming right up. Hey guys, my name is Sean, and on this channel, we go over real estate investing tips, strategies, and current events to help you learn more about the business and to help you become a real estate investing boss. Today, we're going to talk about all-in-one loans. Thank you so much to one of my YouTube followers who watches these videos and asked me if using an all-in-one loan is actually better than getting a traditional mortgage. So today, we're going to explain what an all-in-one loan is, how it works, and if it is better than getting a traditional 30-year fixed mortgage. So an all-in-one loan is basically a checking account, a home equity line of credit, and a mortgage all wrapped into one. And it's great for people who want to own a home but don't want to drain into their savings. The way it works is very similar to having a home equity line of credit, where you have this account that represents the equity in your home. And every single month, you can just take whatever payments you have from your full-time job or whatever businesses that you might have and put it into this checking account. The money in your account represents the equity in your home, so the more money you have in this account, the more your balance is paid off. So as an example, imagine your home is worth $500,000 and you put 20% down or $100,000 for the down payment of the home. So now you have this account with $100,000 into it, and every paycheck you get, you can put it back into this fund to quickly pay down the principal of your loan. Basically, any cash that you have, you just put it back in this account and your loan amount will reduce. The beauty of an all-in-one loan is that if at any time you need to, you can just take money out of this account as if it was a regular checking account. So it's actually very convenient to use if you plan on making other investments or using that cash for some other purchase. This method of being able to take extra cash and put it into this account is great because it greatly reduces the principal balance of the loan. But unlike a regular mortgage, it's a lot easier to take money out, because usually if you make extra principal payments, the only way to get money out is by doing a cash out refinance or opening a new home equity line of credit. So basically, it's like having an extra checking account where you can tap into your home's equity at any point. Obviously, there are some trade-offs here. One of the main trade-offs is that this is an adjustable rate loan. So right now, mortgage rates are at all-time lows. Some people are getting below 3% for their 30-year fixed loans. Having an adjustable rate means that once the interest rates increase, that means that your interest rate will increase as well. And these loans are typically 1% higher than your traditional loans. So if a loan is usually 3%, then you're gonna be paying 4% for this product. There's also a $50 to $100 annual fee for the upkeep, and you typically need a very high credit score to qualify. One of the main downsides is honestly giving you too much access to your capital. So if you're really bad with spending and you don't have a lot of self-control, this product is not for you. Because if you take this product and then you end up going on a shopping spree and start buying cars or watches or jewelry, then you're going to quickly find yourself in a very bad position and possibly over leveraged, and you may lose your house. So this is really for someone who's very disciplined and who has a reason for having an account like this. One of the best uses of an account like this is being able to quickly tap into the equity of your home to then make more real estate investing purchases. This allows you to snowball your wealth incrementally by having this revolving door of funds. Now, another big question is it worth it to put more money into your home when rates are really low? Or is it better to have a long-term loan and then take the rest of your savings and put it into another investment or put it into stocks and bonds? And I think that's a question that everyone needs to look at themselves and think, what is a better solution for them? So we're going to reiterate, this product is great because it gives you instant access to the equity portion of your home. But some of the downsides is that it's an adjustable rate. It's a more expensive adjustable rate, usually 1% higher. You do have some small fees, $50 to $100 per month. You do need a higher credit score to qualify for this product. And if you don't have a lot of self-control, then you can easily screw yourself up by accidentally taking out too much money from your home and not being able to pay that off in the future. So this is really a product for someone who is very self-disciplined, who has a lot of income coming in, who is able to take this extra income and put it back into their home. And by doing this, you're actually going to be able to pay off your loan a lot faster because you're making these extra principal payments every time you put money into this account. So as an example, imagine you have a house that you're buying for $500,000. You get an all-in-one loan and you put 20% down. So that means that your account now has $100,000 that you can tap into. Let's say you do well at your job, you're saving a lot of money, and over time, you put in another $150,000 into the home. Now you have $250,000 of equity, and you have a loan balance of $250,000 as well. If there's an amazing real estate investing opportunity that requires $100,000, it's very easy for you to just go in here, take the money out as if you were writing a check to then make a down payment for this other property. Now your equity goes from $250,000 here down to $150,000, and your loan balance now increases to $350,000. So this ease of access is really great for anyone who probably needs access to large sums of capital without wanting to refinance every time they do it, but also has the discipline to make sure that they don't go out and buy random stuff because of its ease of capital. Overall, is this a good product to have? I'm not really sure. It's definitely not common, and I'm personally not a fan of adjustable rate loans. Right now, 30-year fixed rate is at an all-time low, and if possible, I would just get into that, lock it down for 30 years, and focus on making my money through other businesses to then buy more real estate. Because if you just keep tapping into the equity of one property to then use that as a down payment to buy another property, you're now leveraged on two separate properties. And if you leverage too much when the economy is bad and all your renters can't pay, you might be caught in a tight spot. If you want, you can always make extra principal payments, even with a 30-year fixed mortgage, to quickly pay down your mortgage, which means you're gonna pay a lot less in interest. And if you want, I actually made a video up here that tells you how you can greatly reduce the amount of interest you pay if you make these extra payments towards your mortgage. Well, I hope you guys all enjoyed this video about this all-in-one loan product. It is a very niche product, and I think that most people don't know about it. But again, it could be great for you if you plan on using your home equity as a revolving checking account to then make more investments. Let me know what you guys think. Is an all-in-one loan worth it, or should you stick to more traditional loan products? Let me know down in the comment section below. If you guys enjoyed this video, please smash the like button, subscribe to the channel, and hit that bell notification to see more videos just like this one. Thanks for watching, guys, and I'll see you next time. Take care.